Hi guys, I trust you are all well and welcome to Wednesday. I hope all the trading is going fine and that you're all having a good time. I certainly am. Markets are pretty interesting at the moment. I want to just take you through my view of the 7 markets that we trade, and then we'll hone in and have a look at where I think the opportunities are. So let me start with the opportunities. So first, presently, I have gold in terms of going short. All of these things that I've marked, I was in my trading room earlier on in some live sessions, so I was just marking this, but we'll talk about that just now. So I've got gold short. I've also got UK 100 short, and I'll explain that shortly. Euro versus the dollar up here, presently doing nothing. Remember, the way that we get into trade on the 5-minute time frame, we get our directional bias, for lack of a better word, of the daily time frame. We either going to trade trends, and when we trade in trends, which we see on the daily time frame, we're going into the 5-minute time frame with our trend trading mindset on, which means we are looking for breakouts and pullbacks. High one, low one, those first pullbacks in a trend, bounces of 10 EMA, bounces of 20 EMA. That's one of them. The other way that we trade, again coming off from the daily time frame, is we want to get early into a trend before the trend becomes visible on the daily time frame. So that's the R2.3 reversal into 2 to 3 day trends. That's what we want to be jumping on. There's always opportunities in the market. So right now, if you look at the euro, we are in a trading range. So I'm not going to go into the euro because I don't want to be trading ranges for the day. I'm looking for trends or reversals into trends. You can jump in here and buy low, sell high. Perfectly fine. That's what you want to do. But as far as euro is concerned, if we start to get a big bull breakout out of the trading range and expect the trading range to fail, we can go in, look for a reversal trade back into the trading range. Okay. Then Hang Seng 50. Remember, early in the mornings, I get up and I look to trade that first session of the Hong Kong Stock Exchange. Usually very good opportunities for us to extract good wealth from the market. What you presently have is we're this gap down. So this is an area which would have been suitable, perfect for our R2.3 reversal to 2 to 3 day trend. So if you're in the market and you trade the way that I trade, and you saw that what you want to be doing is looking to find out to get into the market somewhere within here before this appears on the daily. Once it appears on the daily, everyone can see it and we're happy. Now we just look to trade trends. Okay, so reversal strategy. Remember, probabilities, trader's equation. Risk, you gotta control your risk, how much you put into your trade, how you manage your trade in and out. Risk, reward, probability. So that's the three pillars of the trader's equation: your risk, reward, and probability. Reward is where you take your profits, number one, but also in terms of your strategies. How do your strategies enable you to extract your wealth from the market? So in terms of our strategies, our greatest rewards, our highest rewards, the big bang, where we extract the most wealth out of the market, is in these R2.3 strategies, reversal into 2 to 3 day strategies. That's really why we do it. But if you understand the trader's equation, where you have the greatest potential to make huge returns on the money that you've invested in the market, if you're going to make huge returns, it means the probabilities are not in your favor. You can't have huge returns and high probability of success. That's not the trader's equation. If we're going to get huge returns that we are looking for with our return, with our R2.3 reversal into 2 to 3 day strategies, it means the probability of success is less. So with our reversal strategies, I am always working on a 40% chance of probability, which means if I sit back and look at the quarter that has gone past, or half a year, whatever period you're looking back where you've got up to 100 trades, if you've been executing these reversal trades, out of 100 trades, you would have lost 60 of them, 60. Okay, because 40% chance of success, 60% chance of loss. But on those 60%, you manage your trades. Most of them will be break-even trades. Okay, very rarely, well, let me not say very rarely, some of them will be full stopped out. Okay, but most of them will be break-even trades. So you're not going to lose a lot of money. But on the 40% that you win, then we are talking, you're going to be getting 3, 4, 5 times, if not more, the risk that you've put in. And if you are trading 1%, 1% risk means you'll be looking at 3, 4, 5% return. If you're trading 2%, well, it's your scale zone. Then money management comes in. That's another whole different topic together. If you know how to trade, of your 0.5% or your 1%, whatever, if you're comfortable with how you trade and you're starting to see rewards, then you need to jump into money management, because money management is where you're going to start to really extract wealth out of the market. Okay, money management is not simply taking 0.5% or 1% and trailing stop at the end of the day and say, wow, fantastic, I made 1% or 2% on the day. That's good. But then you need to bring money management on that so that 2% becomes 10% on the day, becomes 15% on the day. That's where you want to go. Okay. So, but on the trend trading side of it, higher probability of success, 60% probability of success. So remember the little refrain, when I'm trend trading, I know that 100% of the times I'll be 60% right. Okay. Reversal trading, when I am trading reversal strategies, I know that 100% of the times I'll be 40% right. But trend trading and lower probability, that's when you get your 1-to-1, 2-to-1s. That's what happens with the trend trading. All right, so on Hang Seng, so I just jumped off that to talk about what happens when you take a reversal trade or when you take in trend trades. But on the Hang Seng, we had this gap down that materialized in the market. We had that President Day, etc. And when the market opened, there's a huge gap down. Most gaps will close in the market. Okay, we just don't know when the gaps are going to close. So if you look to the left here, there was a gap up, that high and that low gap up. It's taken the whole of February for the market to try and close that gap. So that low almost closed that gap, and then a gap down being created. As we come into today's session, as far as the bulls are concerned, well, they say I got a double bottom, but we are inside yesterday's range. The bears were strong yesterday. They should have given us a low, a close of the low without this list of buying that took place at the end of the day. So inside day so far, and we just have to wait a little bit. So I will come back to gold and UK 100, where I'm seeing that we have possibly earlier opportunities to jump into the market. S&P 500, again, double bottom. Remember, the red line is low of yesterday, green is high of yesterday. Nothing for us to do here until we get an attempt to break out of yesterday's high and then see if off the 10 EMA market might turn, double top, and we can look for reversal trades. Now with S&P 500, if something is set up in the previous day, of course, I'm looking at it in the session, but the best time for me to get into the S&P 500 is when the US markets open, because then you have the volume from the US markets, New York Stock Exchange, NASDAQ, etc. But you also have the overlap with the afternoon to closing session of the London European session, so huge volumes. So even if nothing sets up early in the day, I wouldn't worry too much about it. Look at it in the afternoon session. Nikkei 225, Japan 225, top 225 companies on the Tokyo Stock Exchange. Again, trading range price action. It's a double bottom, but yesterday's a trading range tails on the top, tails at the bottom. And what the bulls are looking at doing is breaking above that. That's the low of last year, the thick blue line. When would I be interested to get into the market? Because it's a trading range. I look to sell at the top of a trading range, which we must all do whenever you see a trading range, whether it's on the time frame you're trading or daily, whatever it may be. You sell at the top of a trading range, you buy at the bottom of a trading range. So I'm going to be looking to see if we can break out above yesterday's high, which is the high of the trading range created yesterday, which of course will also be a little bit break above the low of last year. I mean, at the end of this week, I'm just going to delete this line because we broke up below it, above it, broke below it. So the low of last year is becoming a weaker and weaker magnet. And I don't want it to clutter my chart, so I'll see where the week ends. But as far as Nikkei 225 is concerned, I'm going to look for a failed break, test of the 10 EMA, maybe micro double top with that low. And if it sets up nicely, a reversal back into the trading range. Bitcoin, as far as the bulls are concerned, after this strong sell-off, they've seen a double bottom. And the bulls want to jump in. So, so there's a lot of buying taking place. Now, when we see a double bottom setup, when we see a double top setup, when we see a wedge pattern setup, we just tick our markers and say, fantastic. Now I'm ready to look to jump into the trade. Okay, we don't jump into the trade right off the setup of a double bottom. We want momentum to be behind us. So if the bulls are strong, they're going to give us a strong bull candle. Depends how far they go for the day. We just want to wait to see if we get a higher low somewhere down here if you're going to buy. Now, if you're going to buy a higher low, it means you're expecting the market to go up, create a lower high. Get a lower high, that lower high will then come back and fail and give us a higher low. So if we get a lower high, and we see all this bearish price action, and then we can start to look for our reversal trade. Okay, 2 to 3 days of selling. If we get up there as a lower high before the higher low set, so we could sell and be able to get out of a trade. If a higher low sets up, we can then buy. Okay, based on time, I will open these other charts and have a look at them. But for now, let's look at what I'm seeing as immediate opportunities for us. This is UK 100, daily time frame. All this stuff looks a bit of a clutter. When I go to the 5-minute time frame, to look a little bit cleaner. Trading range price action yesterday, tails on top, tails on bottom. Okay. After we had micro double top, and which is almost outside candle, we see that high slightly outside, but it's a micro double top, strong bear candle. If you keep going to the left, you see an inside pattern. So whenever we see an inside pattern, and we're looking to go whatever direction, in this case short, because coming off a lower high, the move favored the bears, but because it's an inside pattern, we expect that when you break out beneath the trading range, there might be failure. So this is not a surprise for us, but I'm still looking short. Now, where am I looking to go short? Keep in mind that this blue line that I've put in here, this light blue line, is just to indicate the micro double top. If the market gets there, that's where I'm looking for the market to get. If the market gets there and creates a reversal pattern, I'm going to sell. Okay, so even if it's a strong bull candle on the day, but on the 5-minute, I see a reversal pattern, I am going to sell, looking to come back into the trading range. And who knows whether this low of yesterday can still become a determining factor. Okay, so let's go to the 5-minute time frame. Gets a little bit more interesting. So all those lines that we had, now let me just talk you through them. Okay, some of the stuff that we all kind of used to: low of yesterday, high of yesterday. Now we're looking to sell. So let's just put our FIB and see where the 50% pullback is. Okay, Fibonacci extension. Market opens somewhere there. Okay, so that's midpoint of the trading range, yesterday's range. So remember, we're looking to sell. Okay. We are looking to sell. Open of the day. So far since the open, market went sideways, did break out above that high, good follow through by the bulls. And then we just went back into the trading range. So when you're looking at it, what are the distinguishing features at the moment? There is this trading range. There is an attempt by the bulls to break out. I mean, if you were tracking the market from the open of this session, strong bull candle, outside candle, follow through by the bulls, which broke above that high, and then getting to the high of yesterday. If the bulls were strong, what would have wanted to see from the bulls is a follow through candle of equal magnitude. Okay. Closing on its high, then you say, okay, the bulls are strong, broke above the trading range, had follow through, and perhaps given us another follow through, then our bias would be now saying, okay, the bulls are strong, they're getting follow through, so let's wait for the pullback. But if we remember what we looked at on the daily time frame and the bias that we're getting from the daily time frame, we are looking to sell. So if you are a bull and you're breaking out, what goes through your mind? You say, well, we can clearly see this trading range, that high, that low. So if we break out above it, let me clear some stuff. I'll put them back on just to make sure we got clarity. Okay, that high, that low, there's a 50% pullback. That is the measured move. So the bulls that are creating this, they want to get to that measured move. Okay, we're not jumping on this because our bias is just to sit back calmly and wait for our bear setup to materialize so we can execute calmly. If you're able to process things fast and you can jump in and wait for the market to get that and then get out and change your mind and say, I'm going short, by all means, go ahead. But I cannot do that. I prefer just to wait calmly for the setup to come. What is interesting about the break above this little trading range here is that the measured move is pulling the market up to the level of resistance where we're looking to sell. Remember, this light blue line, as we said, is the micro double top from a couple of days back. So in this zone, that is our sell zone. Now, the reason we mark high of yesterday and that red line at the bottom, the low of yesterday, is because they're key levels of support and resistance. So the high of yesterday is a very key level of resistance. So when the market gets there and fails to break above it, then it pulls back and we come off moving average, the market turns. This trading range here, this price action that is occurring at the high of yesterday is pretty key. And it gives you clues as to how far the market still needs to travel. Okay, so just again, get your Fibonacci retracement. So that high to that low, that low, that high, that low. Okay, and if you just have a look, okay, you can see another level of resistance. But the traders, the bulls who are creating all of this, whether they're trading computers or live trading, doesn't really matter. There is a level of resistance that's going to pull the market up. So I'm very happy and excited about that. Now, what I'm now looking for is patterns that are going to confirm for me that the bears are getting into the market. The bears are getting stronger and stronger in the market. One thing that's clearly evident, if you have a look at all the price action since the attempt to break above that, there are no strong consecutive bear candles. Okay, we're not seeing, bull candles, we're not seeing successive bull candles. Every time we have a decent enough bull candle, we say, oh, fantastic, let's see if the bulls will come back to the market. There is a pullback. There is bears coming to the market. Now, whether that pullback is caused by bulls taking profits out and saying, well, no, let's take any move, take any chance we get, we just take our profits out of the market, or bears stepping in to try and prevent the bulls. That doesn't matter. We just need to understand the forces that are at play. Okay, bull candle, bear candle, bull candle, bear candle, bull candle, bear candle. So it is two-sided price action. The market is going up, which is fantastic, because when I get to this level of resistance, okay, I'm searching for distinct wedge patterns. Okay, out of all that is taking place. So the market went up here, came back, it's gone up. There's very little separation here. It's coming back. I want to see the market coming back again, because every time the market tries to do something 3 times, it typically tends to give up. And when it gives up, the bears will just jump in and turn the market around. I'll be looking to get into the market. Ideal place, the sweet spot, the best place for me to get in the market is going to be somewhere close to this micro double top. I'm just going to put it back up. Our charts will look a bit messy, but that's not a problem. That's where we put in our blue line. That micro double top inside candle was a breakout mode. At some point, the bull said, hey, hang on, we can change this market structure. They created a strong bull candle, but that failed. And the bears came and sold. So the bears that sold here came and sold here and gave us this huge candle. So that's a key level for us. So it is worthwhile to wait, because it will set up. And if we're patient and we're not rushed, we've got time to think, time to work out where to put our stops. And when it eventually sets up, we can jump into it. So how is it going to set up? Who knows? Might get a crystal clear Fed push, and the market might try to get up and fail and give us a decent enough reversal candle, closing near its low, in which case we can jump in and put our entry above there. Or, any other variation. We might end up with a double top setting up in this area. Fantastic. We see a double top, wait for the lower high. So whatever variation we get of bears taking control of the market, we need to jump in. But we just need to wait until we really get up to these levels. No need to rush. So you might say, George, well, what if the bears start to create candles like this with 2 minutes to go, 1 minute, 15 minutes to go? That's good, because that's what you want to see, right? We want to start to see at some point successive bear candles, but it doesn't mean we jump in at that point. We need to wait for the market to get to the levels that we want. But successive bear candles, fantastic. It may take us some time to work it out. Fantastic. We got time. We've got the rest of the session. We've got the US markets coming in with that overlap that I spoke about. So UK 100 definitely on today's sell watch list. Any questions, just pop them into the chat box. Gold also on my sell list for today, but we must sell it at the right price. I left these on when I was in the trading room earlier, this yellow rectangle. Reason is market turned here and gave us a distinct, or let me not say distinct, as you're analyzing it, you would have seen the failure, the outside candles, inside candles in that setup. Perfect candidate for a reversal into 2 to 3 day strategies would have been right here on this candle. After you've seen all of that failed breakout, and see if you can get in. That would be 2 to 3 days of trend, which would have been fantastic way back then. The reason I marked it was not for that anyway, was for us to look back or look forward to where we are presently. Okay. Right here. Level of resistance where the market turned, another level of resistance right here. Outside candle, trading range price action. You know, anytime the market breaks out of a trading range, likely to fail. So we then had an inside candle, which was a bull candle. And if you wanted to trade off that inside outside candle as a breakout mode, bear in mind we are at a level of resistance we're expecting the market to turn, but it is a breakout mode in favor of the bulls. You could take that knowing that most breakouts above a trading range are likely to fail. So if you're taking a trade within that, off that inside candle, you could happily do that, expecting failure at the end time. Could have failed there, could have failed there. But anyway, you would have been rewarded with a strong bull candle. Okay. Doesn't mean when you get a strong bull candle, you forget that you're still breaking out above a trading range. Hence, this failure ought not to have surprised us if we were in the market at that stage. Okay. So that red line, of course, marks yesterday's low and yesterday's high. So that's all it is. And we'll look at that shortly. So that failure would not have surprised us because we still know we are in a sell zone. You know, the market has been controlled by this trading range, failed to break out above that. Now, why do I think the market is, or what other evidence do we have that the market has been controlled by this trading range? So again, that tool that I'm sure you're getting very familiar with, Fibonacci retracement, one of the tools that we use, otherwise Fibonacci extension. If you plonk it in the high of that trading range and the low of that trading range, so one bar trading range, tails on top and tails below, outside candle trading range. So any breakout above that is likely to fail, but how far would the market want to push the breakout if the breakout is successful? The market wants to go for a measured move, always wants to go 99.99% of any breakout out of a trading range. The market wants to pursue a one-to-one extension. So, and it's that level. So even though we failed, the market continued to go up to test that level. So it's no surprise that we're turning there. Okay, so the objectives of this inside candle breakout mode, objective of this break above this trading range by the bulls has been achieved. So the bulls have gotten there, you know, slightly off, depending on how you measure it. But if you're a bull, well, you want to start taking profits. Okay, you don't want to be wishing that, oh, hang on, maybe just today we might get above the measured move, which is why we use measured moves. So if we're in trades and we want to decide where am I likely to take my profits, take your profits off, or take some of the money off that, the wealth that you've created, take it off at the measured move. So if you're a bull, depending where you got in, if you got in at the bottom here or even there, you take some money off there. Now, if bulls are taking money off there, if bulls have been buying and now they're taking money off, if you're a bull, if you're taking profits, you are selling. So there is selling taking place by the bulls and the bears who know what's happening. These strong bears, they've been selling from here. You know, they're going to stop somewhere, wherever they've got to stop. They're selling at this level of resistance. They keep selling because they want to reverse the market. So if you're a bear, strong bear, you've sold somewhere within here and you're selling here and your stop is wherever it may be, because you know you're at a level of resistance. Okay, now for us, seeing all of this and being aware of this and having a strategy that allows us to get into these reversals, the R2.3 reversal to 2 to 3 day strategy. We got to be looking at this and say, man, if I do get the opportunity, I want to jump into the market to sell, put the stop in the right place, and let's see how far we go. So that's why we're looking short. So let's go to the 5-minute time frame. And once you open everything up, it doesn't look as cluttered. Been tracking it and just don't have an opportunity to get in. So here's what's interesting. If you come into the market now and say, okay, George is saying we must look to sell, but hang on, the market opened up here. Let's put the open in the correct place. Market opened here. And the market is down here. Why haven't we sold? Well, let's have a look at it and see why we haven't sold and what you're waiting for. So if you're going to sell, you wanna, if you're any trade or whatever you're selling, okay, what do you look for? You wanna look at where the price is at its highest, somewhere way up there. Let's put back the daily. You wanna be selling up here, somewhere up here, or at best, you know, if the market turns, you wanna get to the 50% of the previous trading range. So you're going to be selling at the 50% level, high of yesterday, low of yesterday. You want to be selling there at the very least. You want to be selling down here when the price already low. That's where bulls are coming in to make this whole thing fail. So you want to be selling at the 50% level. And if the bulls are strong to break beyond the 50% level, we're still in a sell zone. We still see all these levels of resistance. Yesterday's high, that measured move, then you want to be selling a little bit higher. So that's what you got to keep in mind. So when you go down to the 5-minute time frame, that's the time frame that we're trading off, and you have a look, there is a 50% level. There is the sweet spot you want to sell it. So all through here, after the market has opened, okay, there's not. Okay, I got to correct myself. At any candle, you can buy and sell. I've said that before. Because the market there's transactions taking place. Anyway, you can just come and say, well, listen, the way I trade, if I see a bear candle, I'm just going to hit the market, sell the market, and decide where do I put my stop. I put my stop above the trading range. I don't care if it's below there. I've seen a bear candle. I'm just going to say, if it turns, I get out. So you can be always in the market. That's a way of trading. From a price action perspective, called always in the market. If you enjoy that kind of trading, by all means, go ahead and do it. The way that we trade, we look for trends or we look for reversals. So if we're going to sell, we don't want to sell at the bottom of a trading range. You know, the market is open there. There is no way you want to sell there. Okay, the only way you want to sell is if you see a break beneath the trading range, must close near its low, first tick, then you want to see a follow-through candle confirming that the bears are strong, closing near its low. Then you can say, hang on, the bears are breaking beneath that earlier session trading range. If they do that, let me see if I get a pullback, a decent enough pullback for me to trade. But if I do that with a strong breakout and a pullback, stop is still going to be above here. But clearly, have a look at this. There is nothing that's strong about this. So you just watch it, you leave it. And you know you're hunting, you're searching for a perfect trade. The only other place that you can trade. So when I look for shorts up here, the market comes up here to the 50% of yesterday's range, and you get a decent enough bounce and successive bear candles, etc. When I look at that to sell, the market continues to trickle down and there's no opportunities for us to jump into the trade. The next place that you want to look at is the key level of support, which is yesterday's low. So if the bears are strong, they will give us a strong break beneath yesterday's low, closing near its low, which didn't happen. They would give us a follow-through candle. You always want to see the breakout candle breaking out of something or breaking through something, which will be the low of yesterday. We want to see a follow-through candle. And once we see that closing near its low, the bulls have taken control of the market. Then we wait for a pullback to trade. We didn't get that at all. Still on our short list, our sell list, but we need to get the right setup. So what am I waiting for at the moment? Because we're down here, very comfortable to where the bears are strong. They will give me what I'm looking for, my ingredients. Now going to break beneath this, beneath that, follow through candles, come back and test. If that doesn't happen, I'm just going to wait comfortably, let the market do whatever it wants to do. I need to see the market coming back up to these levels to test that high or the 50% level. And then we look to take the trade. So that's gold on the short list. If it doesn't happen today, still have a full day tomorrow, Thursday, and Friday if we trade on Friday. But we are in the sell zone, guys. We just need to wait for the setup. And it can never be emphasized enough. You know, if you get these reversal trades whenever they set up, that was a pretty easy peasy. You will be rewarded by getting to the trades, trends. I mean, that day will definitely have a lot of pullbacks in, etc. So let's wait, whichever way it is. But that's perfect for us. Let's get back and have a look at another one that's on our today's sell, UK 100. Okay, now we're pretty clear about how these levels of resistance work. We want the market to get back up here. So this is beautiful. Bears have managed to come in the market, close beneath all of this pattern. We wanted to see a follow through, but it's created a trading range, which is not a problem for us because that trading range just means if the bulls break above that, they want to do a measure move of that trading range, they'll get up to here somewhere. I'm going to put it in and clutter the charts, but you know, you can do this on and off just to train your mind to see how things be looking in the market. So that high to that low. Okay. Because that is a trade range, tails on top, tails on the bottom, which created a higher low. So if the bulls break above that, market is still going to come back to where we wanted to go. We don't have to leave that on our charts. We'll just clean up our charts. Okay, so there's a lot of things here which I'm aware of. So that level is what you got to watch to see what happens. Okay. And remember our micro double top. So that's the level when I look to sell. We don't want to sell anywhere in here. If nothing sets up for us and the market continues just do a trading range, then we have a trading range day and we're looking to buy low and sell high. But I am waiting for the setup. And let's hope we will have a good enough story to talk next week. So let's just have a quick look at all the 7 markets to see if you're going to stay in the market, things that you can be looking at. Okay, don't worry about this clutter. Gold and UK 100 we've spoken about, presently looking at. Hang Seng 50, the reason I had all of this in is because in my trading room, when I get up in the morning and open up the trading room and trading live with the guys, this is the market that we actively look into to trade, that first portion of it. So nothing much transpired, or a lot transpired, but not for us to trade. 50% pullback, yesterday's height, we had a wage, and we've just kind of hung around in there. So we're not going to do anything. If the market breaks out above this high, low, it's going to get into the zone where we'll be expecting to sell. So we're just going to leave it like that and pop up and have a look at it later. Let's see what other indicators and markers for you. Euro trading range. I mean, if you really want to jump into that, wait for it to break above yesterday's high and create, see if you get a double top there. And selling, that's all good selling. That will give you opportunity to sell off there. You don't have to take the reversal trade. You can wait for a trend to form and pull back to the moving average, and that becomes easy for you to extract wealth out of the market. S&P 500, wait for the US session to open and see if the bulls will try and break out, again, reverse and sell back into the market. Nikkei 225, again, trading range, we spoke about that. When I sell at the top of a trading range, breakout, of the trading range top, double top somewhere, and then we sell. Bitcoin, let the bulls do their stuff. And I mean, if let's just open that. You know, if you are a bull, interesting. So if you are a bull and you've seen all of that, this kind of pattern we have spoken about before, it's a major trend reversal. You have a distinct trend, you have a break above the trend, you have a moving average gap bar. So the bulls were strong enough for the first time in many days to put a close above the moving average. Then, of course, the bears who created all of this tried to resume it, but now you wait for a higher low. So trend reversal, break of a trend line, higher low. So if you are a bull, you are super excited to say, I am going to buy Bitcoin. So if you buy Bitcoin, if you want to buy here, your stop has to be down here. Okay, buy here and your stop down here. And you are saying, well, this double bottom is going to hold. So I'm going to just hold on to my longs that I buy, and to go through all of this might go sideways, but I think that, so you're thinking bullish, that you're going to break above that. So if you're a bull, taking a trade here with a stop here, your rationale is bulls are going to be strong. They'll break above this, even if you get a higher low, it doesn't matter. I'm just going to hold and rely on my stop down here until we break out and I can tighten my stop. But you're hoping that the market gets back to this 56,000 range. How would they do that? Well, if the bulls are strong and they give us 1, 2, 3 follow through and breakout, it's a measured move above this that's going to get there and clear all of this loss. That's the bullish mindset. If you're a bear, you're saying, well, okay, fantastic. I can see all of that. I can see the bulls have broken this trend line. So bulls have got strength. There's a double bottom being formed. But I know, or I think as a bear, that even though there's bullish price action, at some point in the midpoint of this range, we will reassert ourselves as bears, create a lower high, and to create a lower high, our goal is going to be to try and break beneath this low. And if we break beneath that low, now remember, anytime the market turns reversals, we just jump to the 5-minute and we look for trades, whether there's a lower high or there's a higher, a double bottom higher, double bottom what? Higher low, double bottom. We'll just come in and look for trades. But I'm looking at the long-term patterns for bulls and bears. So if you're a bear, you say we're going to sell, create a lower high, break beneath this. And what would be our goal as far as bears are concerned? Well, our goal as far as bears are concerned is just go and smash beneath this low and bring the price down to this 27,000, break beneath the low of last year. So the bears are saying, well, we'll create a lower high and break through this. So that's more the longer term view. For us, let's wait and see. So guys, thank you very much. Keep your eyes on all the charts, but UK 100, let's see what we get. Also gold. So now we are, bears have created a trading range for us. Okay, so trading range price action. So what that means is as the market comes up here, we can start to look for double tops or failed double tops again off that resistance level, and then see if we can jump in and get a short. Thank you very much, guys. Thank you to the guys in the office. We will catch up with you next week, and let's see how they keep on extracting wealth from the market. Thank you. We'll see you again.